You've built a portfolio over decades. Maybe it's substantial, maybe it's modest. You survived 2008. You held through 2020. You know crashes happen. But here's what you probably don't know. The next recession won't just test your portfolio. It will reveal whether you actually understand what you own and why you own it. Most investors think they're prepared for recession because they diversified, rebalanced, and followed the rules. But when Charlie Munger looked at how people actually behave during economic crises, he noticed something. The investors who thrived weren't the ones with the best portfolios before the crash. They were the ones who understood 5 specific principles that separated preparation from panic. You're not 35 anymore with 30 years to recover. You're in your 50s, 60s, or 70s. A severe recession at this stage isn't just a portfolio setback, it's a potential retirement destroyer. And the difference between surviving it intact and being devastated by it comes down to decisions you make right now, before the crisis hits. Not during, before. Before we get into this, do me a favor. Drop a comment right now and tell me where you're watching from. I want to know who's here. City, state, country, just to let me know. This is where investors in their 40s, 50s, 60s, and 70s make catastrophic mistakes when preparing for recession. They think preparation means being defensive, going to cash, cutting equities, avoiding risk. But that's not preparation. That's panic disguised as prudence, and it guarantees you'll miss the recovery that creates generational wealth. Here's what's really happening. Recession preparation isn't about predicting when the crash comes or how severe it will be. It's about building a portfolio and financial system that gets stronger, not weaker, when chaos hits. The investors who win during recessions understood this before the recession started. The investors who get destroyed were optimizing for the wrong outcome. The people who build lasting wealth through recessions understand that volatility is opportunity in disguise. The people who permanently lose ground are fighting to avoid short-term pain while guaranteeing long-term failure, and the difference between these two groups isn't luck or timing. It's having 5 specific systems in place before the crisis hits. You check the news. Recession warnings everywhere, GDP growth slowing, unemployment ticking up, market down 12% from highs, your stomach tightens. You open your brokerage account and look at your portfolio. Whatever the number is, $400,000 or $750,000 or $1.2 million, it feels vulnerable, exposed, at risk. Here's what you think you should do. Get defensive. Move to bonds. Increase cash. Reduce stock exposure. Preserve what you've built. Every instinct tells you to protect yourself. And that instinct, that completely understandable, rational-seeming instinct, is exactly what will destroy you. Let me show you what actually happens. Take someone at age 58 with a portfolio they've built over 30 years. News of recession hits. Market drops 15%. They panic. Not immediately. They're disciplined. But as weeks become months and the portfolio keeps dropping, fear takes over. They sell 40% of their stocks and move to cash. I can't afford to lose more, they tell themselves. I'm too close to retirement. The recession bottoms. Market recovers 50% over the next 2 years. But they missed it. They sold at the bottom. Their portfolio never recovers to pre-recession levels because they locked in losses and sat in cash earning nothing while inflation ran 3 to 4%. They feel safe. They are objectively poorer. Here's why this matters more than you think. The preparation that feels like safety, going defensive, increasing cash, reducing risk, is exactly What guarantees you'll miss the recovery? And missing the recovery is more destructive than surviving the crash. Most people don't realize what's happening beneath the surface. They think recessions are risks to avoid, but recessions are opportunities to exploit, if you're positioned correctly before they hit. The investors who got wealthy during 2008-2009 didn't do it by accident. They prepared. They had cash ready. They had a system that let them buy when everyone else was selling. They understood that the crash itself isn't the risk. Your reaction to the crash is the risk. You did everything right for decades. Maxed contributions, diversified properly, rebalanced annually. And now you're about to destroy all of that work by making the exact wrong move at the exact wrong time. Why? Because you're optimizing for the wrong goal. You're trying to avoid pain, but the goal isn't avoiding pain. The goal is positioning yourself to profit from other people's pain. But that's not even the worst part. The worst part is this. The real damage from recessions doesn't come from the crash itself. It comes from the opportunity cost of not participating in the recovery. When markets crash 40% and recover 80%, missing that recovery means missing the point where wealth transfers from the panicked to the prepared. Let me be blunt. If you don't have a recession preparation system in place right now, before the next downturn hits, you're not just unprepared, you're positioned to be the person wealth transfers away from. Here's what Munger understood that most investors miss. Cash isn't dead money during expansion. Cash is ammunition for recession. And the time to build ammunition is before the war starts. The first preparation strategy is simple, but requires discipline most people don't have. Build 2 to 3 years of living expenses in cash and short-term bonds before recession hits. Not emergency fund, not rainy day savings, liquidity buffer for recession opportunity. Let me show you the mechanism. You're 60 years old, spending $60,000 per year. You need $120,000, $180,000 in cash. That feels like a lot. That feels like dead money earning nothing. But here's what that cash actually does during recession. First, it prevents forced selling. When your stocks crash 45%, you don't have to sell to fund living. You live off the cash buffer. The stocks can crash to zero, doesn't matter. You're not touching them for 2 to 3 years. That buffer is the difference between surviving the crash and being destroyed by it. Second, it enables buying opportunity. 6 months into recession, everything's on sale. Stocks are down 40%. Real estate is distressed. Bonds are yielding 6%. Everyone else is panicking. You're not. You have 3 years of expenses covered. So you take 20% of your equity position and rebalance into the crash. You're buying at prices you'll never see again. That's what the cash enables. Third, and this is what people miss, it changes your psychology. When you have a 2-year buffer, crashes don't scare you. They excite you. You're not worried about running out of money. You're looking for opportunities. That psychological shift is worth more than the opportunity cost of holding cash. Now, here's where it gets interesting. The math on this actually works in your favor, even without recession. Let's say you hold $150,000 in cash, earning 4% in money markets. That's $6,000 per year. You're losing maybe 3% relative to stocks, $4,500 annually. But one recession where you avoid panic selling and buy the dip makes you $50,000 out of $100,000 or more. The opportunity cost of cash is nothing compared to the wealth destruction of forced selling. This is why you felt X when Y happened. When 2020 crashed and you didn't have cash, you felt paralyzed. You couldn't buy. You were worried about your job. You were stressed about your portfolio. The people who had cash buffers, they were calm. They were buying. They made fortunes in 6 months. Same crash, different preparation, different outcomes. The psychology insight is this: humans undervalue optionality. We see cash sitting there earning nothing and feel like we're losing. But optionality has value. The ability to buy during panic has value. The psychological security of knowing you don't need to sell has value. You can't put that on a balance sheet, but it's worth more than the 3 to 4% opportunity cost you're supposedly giving up. Let me show you the numbers for different situations. If you spend $40,000 per year, you need $80,000, $120,000 buffer. If you spend $70,000 per year, you need $140,000, $210,000. If you spend $100,000 per year, you need $200,000 or $300,000. Scale it to your reality, but build it before recession hits. Most people will hear this and do nothing. They'll keep 100% invested because they're afraid of missing gains. Then recession hits. They panic. They sell. They miss the recovery. They spend the next decade regretting it. Don't be them. Here's the truth that contradicts everything you think you know about diversification. Most people have no idea what they actually own. They think they're diversified. They're not. They're concentrated in ways they don't understand, and recession reveals it brutally. The second preparation strategy is conducting a real risk audit. Not just looking at your allocation percentages, actually understanding what you own and how it behaves in recession. Let me show you what I mean. You look at your portfolio, 60% stocks, 40% bonds. You think, I'm diversified. 40% bonds will cushion the blow. But what bonds? If they're corporate bonds from cyclical companies, they'll crash with stocks. If they're junk bonds, they'll crash harder than stocks. If they're long-duration bonds and interest rates spike, they'll crash too. Your diversification is fake. Or you look at your stock allocation. I own 500 stocks through index funds. I'm maximally diversified. But 30% of the S&P 500 is tech. Another 15% is financials. In recession, both sectors get hammered. Your 500 stocks move together. That's not diversification. That's correlation disguised as diversification. Here's the brutal reality. True diversification means owning things that don't crash together. Stocks and bonds used to provide this. Stocks up, bonds up. One hedges the other. But in 2022, both crashed together. The 60-40 portfolio had its worst year in 50 years. Why? Because the hedges failed. Low interest rates and quantitative easing destroyed the stock-bond diversification benefit. The audit you need to do before recession: what actually happens to your portfolio in different scenarios. Not theory, actual stress testing. If stocks drop 40%, what happens? If bonds drop 20%, what happens? If both drop together, what happens? If inflation runs 6% while both drop, what happens? Most people skip this because it's uncomfortable. They'd rather believe they're prepared than actually test whether they're prepared. But that comfort will cost them everything when recession hits and their diversified portfolio crashes 50% because everything was correlated. Here's something that surprised me. The investors who survived 2008 best weren't the most diversified by traditional measures. They were the ones who understood their correlation risk. They knew that their real estate holdings, financial stocks, and mortgage bonds were all tied to the same underlying risk: housing. When housing crashed, everything went together. The ones who survived had true uncorrelated assets: commodities, international stocks from different economies, short-term government bonds, cash. You might be thinking, But I don't have time to analyze correlation matrices and run stress tests. Let me tell you why that doesn't work. You don't need to be a quant. You need to ask simple questions. If the economy enters recession, what happens to my employer? If my employer struggles, what happens to my job, my company stock, my 401k matching? If the local economy struggles, what happens to my rental properties? Are all my bets tied to the same economic outcome? If yes, you're not diversified. You're concentrated. That's the trap. The diversification that looks good on paper fails precisely when you need it most, during recession. Because everything that thrived during expansion, tech stocks, growth stocks, speculative bonds, venture capital, crypto, crashes together during contraction. You thought you were diversified across 10 assets. You were actually concentrated in one bet. Expansion continues. The practical audit lists every major holding. For each, ask, does this need a growing economy to thrive? If yes, it's expansion correlated. Add up all expansion correlated assets. If it's more than 60-70% of your portfolio, you're over-concentrated in expansion. When recession hits, 60-70% of your portfolio crashes together. That's not diversification. Here's what most investors miss entirely. Recession doesn't just crash your portfolio value, it crashes your portfolio income. Dividends get cut. Bond coupons default. Your $50,000 annual income from investments becomes $30,000. But your expenses don't drop to $30,000, so you're forced to sell principal at the worst possible time. The third preparation strategy: build income streams that don't depend on your portfolio before recession hits. This is what separates the investors who survive recession intact from the ones who slowly liquidate at the bottom. Let me make this concrete. You're 62, retired, living off portfolio income. Your portfolio generates $45,000 annually through dividends and bond interest. Recession hits. Companies cut dividends by 30%. Your portfolio income drops to $31,500, but you still need $45,000 to live. Where does the $13,500 shortfall come from? You sell principal. Every year of recession, you're liquidating assets at depressed prices. By the time recovery comes, you've sold so much principal that your portfolio never fully recovers. Compare that to someone who prepared differently. They have the same portfolio, same income need, but they also have $15,000 annual income from a part-time consulting gig, or rental income from property, or Social Security they delayed to maximize. When portfolio income drops to $31,500, they don't need to sell principal. They tighten spending slightly, and their other income covers it. 5 years later, their portfolio is intact. They participate fully in the recovery. The other person is still trying to rebuild. Now, here's where people resist. I don't want to work in retirement. Fine. Then don't retire until you have income that doesn't require work. Social Security is the obvious one. If you're not claiming yet, delay it. Every year, you delay from 62 to 70 increases your payment 7 to 8%. That's guaranteed, inflation-adjusted income for life. It doesn't crash during recession. Use your portfolio to bridge the gap, maximize Social Security, then claim the higher benefit, or build truly passive income before you retire. A paid-off rental property generating $18,000 annually. A small business you sold that pays you $25,000 annually in consulting. An annuity you purchased that pays $12,000 annually guaranteed. These don't replace your portfolio, they supplement it. And during recession, that supplement becomes critical. The decision framework here: stop thinking about retirement income as 4% of portfolio. Start thinking about it as multiple streams, some portfolio dependent, some not. Portfolio provides flexibility and growth. Other streams provide stability and recession protection. Together, they create anti-fragility. For someone at 58 with 7 years until retirement, spend those 7 years building non-portfolio income streams. Delay Social Security to 65-70. Keep one small client for $20,000 annually. Buy the rental property. Build the side business. These take years to establish. You can't build them during recession. You build them now, before recession, so they're producing when you need them. For someone already retired, it's harder, but not impossible. Pick up part-time work in your field. Monetize a hobby. Rent out a room. Claim Social Security if you haven't already. The goal isn't to replace portfolio income. The goal is to create $10,000, $20,000 annually. That doesn't crash when markets crash. That's your recession buffer. The people who make it through recessions without permanent damage always have multiple income streams. The people who get destroyed are 100% dependent on portfolio income that evaporates during the exact years they need it most. Now, some of you are thinking, Charlie, these 5 strategies sound great. But what if I'm already 68 years old? What if recession hits next year and I don't have time to build all this? Let me be direct. You're right to be concerned, but you're asking the wrong question. The question isn't, what if I don't have time? The question is, which of these 5 can I implement immediately? Strategy 1, cash buffer. You can build this in 6-12 months. Redirect contributions, harvest some gains, accumulate cash aggressively. It's not too late. Strategy 2, risk audit. You can do this today. Literally sit down tonight and list everything you own. Stress test it. This takes hours, not years. Strategy 3, non-portfolio income. If you're already retired without it, you can't build passive streams overnight. But you can claim Social Security if you haven't, or pick up part-time work. Something is better than nothing. Strategy 4, opportunity fund. If you don't have one, start now. Take 10% of portfolio, move it to money market today. You've now got ammunition. Strategy 5, spending flexibility. This requires 0 time. Sit down this weekend and categorize your spending. Essential, comfort, legacy. Done. 4 out of 5 of these strategies can be implemented in 30-90 days. The 5th, non-portfolio income, is harder, but not impossible. So stop asking, do I have time? And start asking, which ones am I implementing this month? Because partial preparation is infinitely better than no preparation. And recession doesn't wait for perfect readiness. Now let me show you strategy 4, because this is how you actually profit from recession. This is where preparation becomes offensive, not just defensive. The 4th strategy. Set aside 10 or 20% of your portfolio in dedicated recession opportunity fund that doesn't get touched until blood is in the streets. Munger made a fortune during recessions by having capital ready when nobody else did. 2008-2009, he deployed billions into companies at prices he'd never see again. He didn't time the bottom. He didn't predict the crash. He was prepared with liquidity and a plan. Here's how this works for normal investors. You have whatever portfolio size you have. Take 10 to 20% and designate it Opportunity Fund. It sits in money markets or short-term treasuries earning 4 or 5%. You don't touch it. You don't invest it. You wait. Recession hits. Market drops 20%. You do nothing. Market drops 30%. You do nothing. Market drops 40%. Now you deploy. You take that Opportunity Fund and you buy index funds at prices 40% below where they were. You don't try to time the bottom. You don't wait for the perfect moment. You buy when things are clearly terrible and everyone is panicking. Let me show you the math. You have $600,000. You set aside $120,000, 20% in Opportunity Fund in 2007. Market crashes 50% in 2008. Your remaining $480,000 drops to $240,000, but you have $120,000 in cash. When market is down 40%, you deploy the full $120,000. You buy $120,000 worth of stocks at 40% discount. Recovery happens. Market returns to 2007 levels by 2012. Your original $480,000 in stocks is back to $480,000. But the $120,000 you deployed at the bottom is now worth $200,000. Bought at 40% discount, now at par, tracks a 6-7% gain. Total portfolio, $680,000. You not only recovered, you gained $80,000 by being positioned to buy the crash. Compare that to someone who was 100% invested. Their $600,000 dropped to $300,000. They panicked, sold half. They put $150,000 in cash, kept $150,000 in stocks. Recovery happens. The stocks go back to $300,000. They never re-enter. They end at $450,000. They lost $150,000 permanently by not being prepared. Now here's where it gets interesting. The Opportunity Fund doesn't just work for market crashes. It works for any dislocated asset. 2020, real estate and travel destinations crashed. Airbnb properties selling at 30% discounts. People with cash bought them. 2 years later, they're worth full price plus appreciation. Oil crashed to 20 barrel. People with cash bought energy stocks. Within a year, oil was $70. Stocks doubled or tripled. The psychology here is critical. Having an opportunity fund changes how you experience recession. Instead of fear and dread, you feel anticipation. When is my buying opportunity? You're not worried about your portfolio crashing because you know the crash creates the opportunity. That psychological shift prevents panic selling and enables wealth building. For pre-retirees 10 years out, start building this now. Take 15-20% of new contributions and put them in Opportunity Fund. Don't deploy them into stocks. Let them build. When recession hits before you retire, you deploy and buy discounted stocks that will compound for your entire retirement. For recent retirees, harder but still doable. Take 10% of portfolio and designate it opportunity only. Accept that it earns nothing for now. But when recession hits, that 10% becomes 15-20% by buying the crash, and your retirement is permanently more secure. The people who build generational wealth during recessions aren't lucky. They're prepared. They have liquidity when nobody else does. They're buying when everyone else is panicking. And they position themselves for this before recession hits, not during. Here's the final preparation strategy that nobody wants to hear. You need to know, right now, before recession, how much you can cut spending if you have to, not theory. Actual line-by-line budget flexibility. Most retirees think they need $60,000 per year. But what do you actually need? $45,000? $50,000? $55,000? The difference matters enormously during recession. If you can cut from $60,000 to $48,000 for 2 to 3 years during the crash, you preserve $24,000 to $36,000 in principal. That compounds to $60,000, $90,000 over the next decade. But you need to know you can cut before you're forced to. Let me show you why this matters. 2 retirees, both with $500,000, both spending $50,000 annually. Recession hits. Portfolios drop 40% to $300,000. Person A has inflexible spending. They need every penny of that $50,000. They withdraw $50,000 from a $300,000 portfolio. 16.7% withdrawal rate. That's catastrophic. After 2 years of this, they're at $200,000 and their portfolio never recovers. Person B prepared. They know they can cut to $3,750 if they must. No travel, minimal dining out, defer home improvements. During the recession, they cut to $500. They withdraw 12.5% from $300,000. It's still high, but manageable. After 2 years at reduced spending, they're at $225,000. Recovery happens. They return to $50,000 spending. By age 75, they're back to $450,000. They survived. Same starting point, same recession, different preparation. Person A destroyed their retirement. Person B survived intact. The difference? Person B knew before recession exactly what they could cut and how to do it. The audit you need to do. Break your spending into 3 categories: essential, housing, food, utilities, healthcare, comfort, travel, dining, entertainment, hobbies, legacy, gifting to children, charity. Add them up. Essential might be $35,000, comfort $20,000, legacy $10,000, total $65,000. Now, in recession, you can cut to $35,000 if you absolutely must. Survival mode. You can cut to $45,000 by eliminating legacy and reducing comfort. Sustainable mode. You can maintain $65,000 in normal times. Comfortable mode. Having that flexibility mapped out before recession hits is the difference between panic and planning. Here's something that surprised me. The retirees who cut spending during recession don't feel deprived. They feel smart. They're not cutting because they're poor. They're cutting strategically to preserve principal during temporary market dislocations. That mindset shift from deprivation to strategy makes the cuts bearable. You might be thinking, but I don't want to live on less. I saved for 40 years to enjoy retirement. Let me tell you why that doesn't work. You saved for 40 years to have security and freedom. Security means knowing you can weather recession without destroying your portfolio. Freedom means having options during crisis. If your only option is maintain spending no matter what, you're not free. You're trapped. And when recession forces spending cuts anyway, you'll make them chaotically instead of strategically. That's the trap. The retirement spending that feels non-negotiable becomes the thing that destroys you during recession. The retirees who prepare spending flexibility before recession hits preserve their portfolios during the storm and emerge with wealth intact. The ones who insist every dollar is essential end up broke. The psychological shift required from I deserve to spend what I want to I deserve security more than luxury. Both are valid retirement goals, but only one survives recession intact. Remember what I said at the beginning. You've built a portfolio over decades. You survived previous crashes, but the next recession will reveal whether you actually understand preparation versus panic. Now, you know the truth. The question isn't, will there be another recession? There will be. The question is whether you've built the 5 systems that separate prepared investors from destroyed ones. Because recession doesn't destroy people randomly. It destroys the unprepared systematically. So here's what happens next. Most people will hear this and do nothing. They'll stay 100% invested because they don't want to miss gains. They'll have no liquidity buffer. They'll never audit their risk exposure. They'll be 100% dependent on portfolio income. They'll have no opportunity fund. They'll have no spending flexibility. And when recession hits, they'll panic, sell, miss the recovery, and spend the next decade broke and bitter. A small group will hear this and act now. They'll build 2 to 3 year cash buffers. They'll audit real correlation risk. They'll create non-portfolio income streams. They'll set aside opportunity capital. They'll stress test spending flexibility. And when recession hits, they'll be calm, positioned, and ready. They'll survive the crash, buy the bottom, and emerge wealthier than before. The difference isn't intelligence. It's not luck. It's not market timing. It's preparation. It's building anti-fragile systems before crisis hits. It's understanding that recession isn't a risk to avoid. It's an opportunity to exploit if you're positioned correctly. Wealth through recession doesn't belong to people with the biggest portfolios. It belongs to people who prepare, who build buffers, who understand their risks, who have multiple income streams, who keep powder dry, who know their spending floor. Recession preparation works like this. Build the systems now. Execute them later. The people who prepare before recession profit during recession. The people who prepare during recession get destroyed. That's how survival actually works. Your preparation determines your outcome. Build accordingly. Now, if you want more brutal honesty about building wealth and achieving financial independence, timeless principles that actually work instead of get-rich-quick garbage, subscribe to this channel. We don't promise easy. We don't promise fast. We promise truth.